Hi everyone, this is Shaurya and you are watching Money9 Jhatpat. Economic data across the world is disappointing, but the market is in a mood to roll. Retail sales in China, Europe and US are on a downward trend for the past few months. US actually went in technical recession. Manufacturing and services PMI across the globe are falling continuously for quite some time. However, consumer confidence is reviving in India, US and China, but it is falling in Europe. Now, this revival in consumer confidence is actually giving hint about market rally. Well, let's look at equity markets. Indices like Sensex, Dow, FTSE, CAC, KOSPI all went up by more than 5% in 1 month. In fact, Indian and US markets have increased by more than 10% in 1 month. So, is it just a dead cat bounce or is there something fundamental? Well, let's try to solve this puzzle. Actually, it's about the what kind of headwind is more prevalent, inflation or economic slowdown. Yes, inflation seems to have peaked. International commodity prices ranging from crude oil, copper, aluminium, palm oil are cooling. Let's look at commodity indices for a broader picture. Bloomberg Commodity Index declined more than 6% and S&P GSIC is low by more than 12.5% in the past 3 months. But that's because we are heading towards economic downturn. So, we can think of this like economic automatic stabilizer. This translates into less aggressive interest rate hike by central bank. For equity market, economic slowdown is smaller risk than aggressive interest rate hike because we are in a situation of stagflation, having both high inflation as well as low economic growth. Now it seems, at least on one issue, the worst is behind us. While for economic downturn, the question is how deep and how long will it be? Right now, consensus is that it won't be that deep. So, the biggest fear of inflation is subsiding and economic downturn is perceived to be shallow. Hence, markets are up. Markets know that it is lower due to temporary issues like supply chain disruptions, which are improving, and lockdown, which is also improving. Consumer confidence across the globe fell when commodity prices were sky high. Now, fall in commodity prices triggered revival in consumer confidence globally. On a structural level, forces like deglobalization, decarbonization, demographic changes and geopolitical uncertainties brought tectonic shifts in the world. Here 3Ds, which is deglobalization, decarbonization and demographic changes, will actually pave the road for global capex revival. With reshoring, firms will invest money to set up plants in friendly or nearby countries. With decarbonization, firms will invest in alternative sources of energy, while demographic changes and shortage of labor will induce investment in digitization and automated production processes to fill up cavity created by lower workforce. Now, geopolitical instability has rippled up the international stable business environment. So, to survive high tides, firms need to innovate and adapt. All this will lead to higher productivity as well. At the same time, even though trade in goods may reduce, trade in services may continue to rise. Therefore, transmission of data and knowledge will continue to flow across the border, and this will propel productivity, innovation and catch-up effect in the emerging economies. It can even reduce inequality to some extent. Now, all this will lead to higher capex investment despite high interest rates, as anticipation of increase in real capital will drive investment and not the availability of cheap capital, which was the case in last decade. Right now, market has factored all the inflationary headwinds and is in process of factoring these structural changes, and it's on the rise. However, near-term risk can emerge from labor market. Workers are demanding higher wages, and given the tightness in labor markets in developed countries, workers are demanding higher wages and given the tightness of labor market in the developed countries, coupled with deglobalization, lower access to cheap labor, bargaining power of workers in developed countries has increased. So, inflation expectations of workers is not anchored, then inflation can spiral upwards. Hence, central banks need to specifically focus on not just controlling inflation, but also on clear communication with common folks. Other short-term risk is supply glut, as firms may overcompensate for recent supply shortage. However, given the contrasting nature of these two risks, only one of them will prevail, and in the current scenario, supply glut is more likely than wage inflation spiral in near term. Hope you like this content And for more such content, do follow us on Facebook, Twitter, Instagram and YouTube. And don't forget to download our app on Play Store and Google Play Store.